Good day, fellow investors. I think it's always good to remind oneself that we are in an everything bubble and we have to be careful when we invest in such an environment. I was just looking at this in the Financial Times, and this is the Miami Luxury Properties Index. So you can see here, of course, the real estate bubble when everything was crazy. And now, fast forward 15 years, and everything seems twice as crazy as it was here when the world went into the biggest financial crisis since 1932. This is something indicative. Then if we look at, for example, even stocks, look at this chart for Miami. Look at Apple's stock price. Yes, it's a great business, it's a great company, but also look at what the chart is saying. We have this year Bitcoin recovering from 15,000 to 40,000. So there are still many excesses in the financial industry, and that leads to bubbles, and bubbles usually sooner or later pop. What happened there? Well, we have asset prices ballooning on excess cash, of high liquidity in the system, low rates, compared with unreal expectations that this time is different and things will never change, and that usually ends up badly. But the key is that there is already some kind of softening in the financial markets, but these asset prices tend to react with a delay. Let me show you what has happened, what has led to the current situation, and then we can discuss how to navigate these seas. So first, if we look at the Fed's balance sheet from, let's say, relative normality before the great financial crisis, the Fed's balance sheet is still now at, what is this, 8 trillion, is still at 10x. So the Fed's balance sheet has expanded 10 times, and of course that has led to an increase in liquidity in the markets. And interest rates have been at zero for almost 15 years. Now we have had the last year this increase, but we still haven't seen the reflection on this. And plus, the expectations are that the Fed will bring down interest rates pretty quickly back to 2.5 because this is not sustainable. So the market is currently expecting that things will be great again, low interest rate. The 30-year fixed rate is now 7%, but the still bubble environment was 3%. And I've heard that many of you refinanced, as we were saying, that was the smartest thing to do when these 30-year fixed interest rates were very low. Practically, you are now making 2% on your 3% 30-year mortgage if you nailed it a few years ago. But this is not just in the US, this is a global bubble. Because if you look at the purchases from the European Central Bank, you can see these huge amounts of inflows. And they just started selling something, but there is still so much money in the system that they would need to sell for years at this rate to make an impact. Still so much money floating in the system. This is just a blip in how much they have expanded the balance sheet. Plus, governments are still spending. Everyone is looking at the debt to GDP, the yearly deficit, and thinking, okay, 6% is not bad. But if you look at the US government, they're spending 23% more of what they make. Imagine that you make $100,000 a year and you spend $123,000 every year. How long would you be able to last? Of course, the governments can print their own money, but if you print their own money, sooner or later you destroy your own money, and then it looks very ugly. And I'm going to give you one video here that's a must-watch if you haven't. Spitznagel predicts an apocalyptic market crash when the chickens come to roost, when it's clear that this is an unsustainable environment, and in that environment, we as investors have to raise our future lower level wealth. Watch that video because it explains in depth what is going on and how we can deal with it and when will it break. So we as investors, we cannot know exactly when it will break. Of course, it's nice to enjoy the party as long as Miami luxury prices go up, but if you look at what happens when this reverses, that's a 50% decline, and a friend of mine actually lost $600,000 on 2 apartment investments when simply the bank said you need to put more collateral because the price is going down. He didn't have it. The bank sold their apartments and the bubble quickly deflated. Same here. If money reverts, the bubble could quickly deflate, which is again a 50% down. So the bubble is still going on. There is still this excitement around. You have money, you bought your gifts for Thanksgiving, you're now looking for Christmas, where to go, and that's the general sensation in Europe and also in, as I feel, in the US. It's still, everything is still strong because of the quantity of money that was pumped into the system that's slowly deflating. There is some softness, but not yet enough. The first thing to do when it comes to investing is to simply avoid the clear bubbles, the booms, because if it reverts, those will be the ones hit harder. And then, yes, the solution to that is inflation. The Fed will not be able to avoid inflation somewhere in the future, but that will lead to more excesses. Maybe Miami luxury properties will go even higher, but that's a risky game to play. Fundamentals are the way to go, but keep in mind, in a crash, if Miami crashes, also those cheap fundamentals will go down because that's how the market moves, but maybe a little bit less. Maybe you will have some dividends to reinvest in those cheaper prices and increase that lower level of your long-term wealth. We cannot fight against bubbles, that's too costly. We cannot know when will those pop. We can just look at the fundamentals, and when we are happy with what we are buying, accepting the volatility that the future will bring, and then invest and try to own more of the global asset wealth pie, and that's about it. As we have discussed in this video, portfolio strategy, you must be or robust, that whatever happens you don't care, or anti-fragile, so that you can buy more when things go down. Thanks for watching. Looking forward to see you in the next video.